Have you ever been issued with a Division 293 assessment and had no idea why or what it was for? Hi, I'm Jennifer Richardson and I'm the Director of 123 Financial Group. Today, I thought it would be helpful to talk a bit about Division 293 and whether or not it may be relevant to you. Division 293 was brought in by the Labor government back in the 2012-13 financial year, and at the time it was billed as being necessary to make the taxation of superannuation fairer. The reality is it probably had more to do with the billions of dollars in superannuation that have a taxing rate of only 15%, so much lower than any other tax rate. After all, personal tax rates scale from 0% for taxable income under $18,200 to 45% for individuals whose income is above $180,000. With superannuation being taxed at a flat rate of 15%, it means that high income earners who are able to redirect income into superannuation instead of being taxed in their own names can potentially save 30% on every dollar that they put into superannuation. For most of us, and in particular high income earners, saving for retirement through superannuation is a great idea, but a Division 293 assessment can come as a bit of a shock. Division 293 is an additional tax on super contributions that is levied on individuals who are fortunate enough to have what the ATO deem a high income. This tax is issued to the individual directly, not to the superannuation fund that receives their contributions. Currently, this income threshold is $250,000, but as with all things with the tax office, it is not just based on taxable income. The income threshold of $250,000 is adjusted taxable income, the same as is used for calculating the Medicare levy surcharge, except ignoring the reportable superannuation, but adding back in the concessional superannuation contributions received by your superannuation fund. Concessional superannuation contributions are those that have been paid from pre-taxed income. And unlike other thresholds, the Division 293 threshold is not being indexed, meaning that it is not increased by CPI as inflation eats into your income. The lack of indexing means that it is yet another tax that diminishes people's ability to self-fund their retirement, as CPI and wages growth will have moved more and more Australians into the Division 293 threshold. Prior to the 1st of July 2017, the combined income threshold was $300,000. The government's rationale for reducing the threshold was to make the superannuation fairer and more equitable across all income levels, not that they wanted to increase their revenue. How will I know if I need to pay a Division 293 tax? Well, you will be sent a Division 293 assessment once you've lodged your tax return and your superannuation fund has lodged what contributions they've received on your behalf. This means that your Division 293 assessment may come sometime after your income tax assessment. A Division 293 assessment is for 15% of the superannuation contributions received by your fund or the amount that is over the threshold, whichever is the lowest. For example, if your Division 293 income is $240,000 plus Division 293 superannuation of $15,000, then your Division 293 assessable income would be $255,000. In this case, you would only have to pay the Division 293 tax on the $5,000, not the full $15,000, as this is the amount that is over the threshold. Your Division 293 assessment would be for $750, being 15% of that $5,000. Consider this example from the ATO website. In the 2021 financial year, Mark earns $320,000 and his employer contributes $20,000 to his super fund. Mark's fund pays tax of $30,000 on his concessional contribution. That's 15% of the $20,000. If Mark's employer had not contributed to super, Mark would have earned $340,000 and the additional $20,000 would have been taxed at his marginal rate of 47%. So Mark would have paid $9,400 tax on the additional $20,000. The tax concession Mark would have received on his contributions is $6,400. By paying a Division 293 tax of $3,000, 15% of that $20,000 contribution, Mark still receives a concession, but it is reduced. The total amount of tax paid on the contribution is $6,000, which is 30% on the $20,000, made up of 15% tax in the fund and 15% Division 293 tax. The tax concession to Mark is now only $3,400. Essentially, the extra 15% tax brings the tax on the superannuation contribution up to 30%, as this is seen by the government as being fairer to the taxing system. Division 293 is assessed on that year of income only, and there's no opportunity to average out your income. This means that if you were to get a big bonus in one year, or have a large capital gain event, or you receive a redundancy, you would be required to pay the Division 293 tax in that year, even though that income is a one-off event. Division 293 has the greatest impact on individuals who are only just over the $250,000 threshold, rather than those who earn well above the threshold. What happens though if you are on a defined benefit? If you are in a defined benefit fund, the payment of your Division 293 tax is generally deferred and included as a debt in your ATO account. Interest will be added to the account balance for any amounts outstanding at 30th of June each year. The tax will only become payable when a benefit is paid in relation to your defined benefit membership, which is usually on retirement. However, you can make a voluntary payment to avoid interest if you prefer. A deferred Division 293 tax debt must be paid when the super benefit becomes payable from the defined benefit account. Your fund must advise the ATO within 14 days of the first of the following events happening. So that is receiving a request to pay a superannuation benefit, or the superannuation benefit becomes payable. Now, if you need to know more information on Division 293, please contact our office.